Real quick, before we jump into the show, we created the Collecting Keys podcast to be a real estate investing podcast that is created by real estate operators for real estate operators. And we want operators everywhere to know what it really takes these days to be successful in this business, rather than all the fluff that all the other content creators and podcasters out there make. And so one of the challenges with this is that it's challenging to grow because most operators are too busy out there working, right? And they aren't always learning or actively seeking new learning material. And so if you could please share this show with any fellow operators you can text it to them, you can post it on your socials, you can leave us a good review that you then share somewhere. That would be amazing. But really, whatever, it really helps us continue to get excited to create content. And it will also help you because everyone that you expose us to will get better as a real estate operator and close more deals. So if you could do that for us, it would really mean a ton. And otherwise, we appreciate you guys. And let's get into this episode.
One thing I think we mentioned, honestly, months ago that's finally starting to come to fruition is lenders reaching out to people and saying, hey, we got some bad deals on our books. You want to take this over for what's owed?
Welcome back to another episode of the Collecting Keys Real Estate Investing Podcast. You got me here, my man, Dylan, the baddie from Cincinnati.
I hate that. I hated that.
I wanted to come up. I have a whole other one too. I got a whole lineup for you, man. But he's the baddie from Cincinnati. Anyways, the real estate investing show by operators for operators. We're talking about crazy stuff, including warrantable, non-warrantable condos. Mike is not here. He's gallivanting out in Europe this week. He's 2 weeks back to back. He's left me here to survive in the wild on my own. And you guys are the lucky podcasts are even posting right now, but they are because we're here for you. Dylan and I are dedicated to the mission here at hand, which is giving you entertainment.
What's nice is I just find some bullet points to talk about and then I show up. You guys do all the back end stuff.
And you too. And I just show up and I read your bullet points. I'm like, damn, that's intelligent. Dylan knows more than me. Anyways, yes, welcome to the show. Let's start off because this is actually a really good conversation is warrantable, non-warrantable, because it's things that I have had to learn over the years. The first time we learned about like issues with condos was the condo that we still own. Well, we've had now for 2.5 years, which we are under contract to sell, which is awesome. We're really walking on a tightrope here to see if this thing will actually sell. If the traditional, like I think they're doing a conventional loan, will actually fund this thing. So more to come maybe in like 2 weeks. You guys will hear more about that. But we have, as a lender, we ran into an issue. There was what warrantable and non-warrantable means. And I don't know all of the terms. So there's going to be a bunch of things that will actually fall under what is going to be warrantable and non-warrantable. And when we talk about that we're talking about the title being warrantable or non-warrantable. So typically, if it's non-warrantable, like you said, Dylan, you're not going to get the FHA, the VA. You're likely not going to get conventional. You can get DSCR loans. And I don't want to say you can't get a conventional loan, but it's less likely. You still might be able to find a lender to do it. You can get commercial loans on them from like a local credit union, which is like what a typical investor is going to get, or you can get a DSCR loan on it, but they're going to want really big LTV spread. So I'll give you the example of what we dealt with recently. And I'd love to hear kind of exactly on yours why it's non-warrantable, because there's going to be a ton of differences or reasons why. So we were looking at a 5-unit property. So the owner, the seller, owned all 5 units. They had them, and then the buyer was buying basically the whole building. So you would think, oh, it's just an apartment building. Well, the way it's set up is they're set up as condos in the county records. They have their individual parcel numbers. They're not like separate plats, but they have individual parcel numbers. It's kind of a big deal. You'd have to do some, I don't know, you'd have to do rezoning and maybe some replatting. I don't know exactly in that specific market because it wasn't here in Spokane. However, that's why you'd be like, okay, so it's an apartment building, which the difference though is with this being a 5-unit is that kind of pushes you outside of the 1 to 4 unit DSCR loan and pushes you more into the commercial side. So that's a different loan product as well. But for what we were doing a DSCR loan for her. Well, the seller wanted cash because he lived in one of the units. He needed cash right away. And the lender she was working with, the DSCR lender previously, gave her 65% LTV because it was non-warrantable. So she took the cash she did have, bought him out of 2 of the condos, and then came to us to get the other 3 because she was really bummed out that other lender wanted 65% LTV. Well, we were able to increase the LTV a little bit, but because they're non-warrantable, we could not increase the LTV enough to get the deal done. So I said, hey, go back to this person and just, instead of you coming out of pocket a bunch more money to get that LTV, just go ask him if he'll seller finance the rest. Like, you just got him a huge chunk of money for him to go pay cash for his own new property, go seller finance it. So then we just ended up not doing that deal. But the reason why it was non-warrantable was because the same owner owned too much percentage of the HOA, because she was owning 100% of the HOA. So they would not warrant it because of that, meaning you had to have a riskier underwriting package for that loan.
Kind of the same thing that they told us is it basically, my lender told me if it's over 50%, so I guess 50% or under is okay. But like, that's just an automatic, like, non-warrantable, because I guess they have too much risk in one person.
Right.
And the other part of this that didn't help, this has been a big freaking mess, is that the previous, there's only like 12 units in this whole complex. But the guy who's in charge, he was the president, the treasurer, like he was everything for the HOA, like board member, and he died.
Oh, shit.
And he didn't really keep good records of anything.
Oh, man.
So I really don't know what's going to happen with how it's going to go perform. Because, like, you know, they're asked for the past couple of years financials, like insurance is on the property, like on the condo, it's like the complex itself, all this stuff. And it's like, so point being is like, now if ever I buy a condo on the front end, it's like, you got to figure this shit out immediately, like on the front, is you're going to have problems in the back.
So are you trying to buy the condo, like, set you with a cash loan, or are you like trying to get long-term financing on it straight away?
No, so we bought it cash and we flipped it. We're going to sell it. And the end buyer is the one that's looking for like a conventional loan, like an owner-occupied loan.
That's a pain, dude. That's exactly what happened to us. We bought ours for cash, dixed it up, had a huge chunk of money coming back to us. And then it wasn't that it was non-warrantable, because the actual condo itself was warrantable. What we ran into as an issue was the HOA's insurance didn't meet the requirements of the conventional lender that the buyers were using. And the reason why is because it was set up, it was so stupid. And this is why you do need to look at, don't trust other people to do your due diligence on condos. Read the documents, figure it out, throw it into ChatGPT, ask it what is in here that you need to pay attention to and what's like a risk and all that, because you got to do this. We didn't do this, and this is how we learned the lesson. We just assumed, condo's got its own insurance. We got a walls-in policy for our unit as well. Mm-hmm. Well, the way it was set up, the only way to get insurance on the units, because imagine a cul-de-sac with like 4 duplexes. That was this HOA, like, total. And the only way for them to get insurance was to do it through the HOA, because the guy who built them basically sold them on seller contract. But then he wanted to get out from underneath the seller contracts. And so then he took them all from individual parcels to one giant parcel, created this HOA, and essentially made it so that there's a master insurance policy for everybody. Because if you imagine, like, if you're having an adjacent unit, what if that unit's like stove catches on fire and burns your unit? It's like, who pays for the loss, right? And so they need the building, the walls out insurance. And so think of it as like, if it's a high rise condo in Florida, or like the one you're looking at, Dylan, in like Cincinnati, you have to have that policy in place. Well, our insurance was only cash value, and it was because there was too many claims, because there was 3 insurance claims in like the last 5 years. 2 of them were for the same person whose basement flooded twice. Idiots. And basically the insurance agent was like, no, we're not going to increase your insurance amount. So the cash value of the policy was like $290, and we were selling it for $340, and the loan was going to end up being like $315, and we couldn't do anything to increase the insurance at the time.
That's awful. Yeah.
It sucked. It was a pain in the ass.
Yeah, I don't even know. Like, this is proof sometimes in real estate, sometimes like things outside of your control happen.
Nothing you can do about it.
But like, so what ended up happening? You just keep it, and now you're like...
Yeah, we've rented money, and we rented it out, made and lost we probably broke even. We're losing money right now because we have it listed and it's vacant. And so I've fought tooth and nail the last couple of years to get the insurance changed and increased, and we've hired lawyers and all that sort of stuff. We have it under contract right now. Funny enough, for the same price. We actually had it under contract 2.5 years ago, but with seller concessions. We had like an $11,000 seller concession. We have to replace the roof, and we have to put a radon mitigation system in.
Is the roof not part of the HOA taken care of?
No. So you have to, the HOA bylaws say you and your housemate, whoever owns the other half of your duplex unit, the other half of the duplex unit, have to just figure it out on your own.
Wow.
Well, guess what? this guy doesn't have the money to do it. So we're putting him on a payment. He's going to give us like $2,000. It's going to be $11,000 for the roof. He's going to be on a payment plan to pay us back. We'll put like a mechanics lien on his house or some sort of lien on his house or his unit.
Yep.
And then we just replaced the boiler because the boiler failed right before this, was just $7,000. So we're just getting our ass handed to us on all this stuff. And just a note, the way we're doing is I'm not replacing all that stuff until it closes. And I've agreed to hold that money in escrow. And I've got the contractor contracts all lined up for it to be executed the day after closing.
Yeah.
Because the last thing I want this person's lender to do is say, sorry, we're not going to do it because the insurance.
And you've already poured all that money into it.
Exactly. So we're just kind of holding off on that. So if this thing falls through, we'll still own it.
What's funny is, no, it's not funny, but like when we bought it, I was like, condos are kind of sweet because like I don't have to worry about the roof and the windows. I just have to worry about the cosmetic on the insides. Turns out that's not always true. So there's that. So I don't know. For the audience, just be more careful with condos than anything.
In your situation, the non-warrantability was because there's one owner with more than 50%.
That, and I think it's a combination of the lack of documentation.
The lack of, yeah.
But yes, that's the president, treasurer, same guy owned like 6 of the 12 too. So it's also a problem.
Yeah. That is a big deal. That like having the bad records is a big deal. You want to look at to make sure they have reserves. Lenders will want to know how much the condo association has in reserves, and they'll have some requirement for reserves for repairs and all that stuff.
Exactly. So this part of the due diligence process, add it to like a checklist if you're out there and like there's things that like you don't really think about, like stuff like this. See if it's in a flood zone is another big one, especially if you're buying cash up front. But you mentioned the seller concessions you guys have to give. I like the way that you structured that, like just doing it post-closing, because that way you're not screwed if they back out. I have I'm out $15,000 in seller concessions on a duplex that we're selling, but 13 of the 15 is a new roof.
Oh, really?
Yeah. So like, it's not really that bad, but I told them I would go ahead and do it. But now I might go back to them and be like, hey, here's a contractor. Here's the half paid invoice. Here's this. Maybe I'll just wait to do it after we close.
Yeah. It might make more sense because the worst thing that can happen is they back out, right? And now you've got this damn roof that you paid. I mean, in your case, at least the new roof is okay. Maybe you did need it anyways, whatever. That's fine.
I mean, it's a slate roof. It's pretty old.
Okay. Yeah, exactly. For us on our stuff, like the radon mitigation thing is this joke. I always say no to that, but these buyers were like going to walk if we didn't do it. And after like the concessions, the sale price comes down enough to where we're like so close to it being what the insurable amount is. And I'm like, I'm willing to like just at least go through this process with these people to find out if it works, because we're just like right there on the cusp of it working.
And there's something to be said about being done with it and getting your money back.
Exactly. Dude, we're so done with this thing. It sucks. We'll get some cash back, which will be nice, and we'll just reinvest that in our business and call it good. But the seller concession thing is a legit issue, and people are getting their ass handed to them if you're not accounting for that in your numbers up front. Because it's almost like you flip a perfect house, and the buyer's going to be like, this house is awesome. You pass inspection. I want $10,000 in fees paid.
And you're like, okay, because you felt like this duplex, I didn't really have any other offers. So I'm almost feel like an obligation to be like, I don't really want to piss them off too much.
Well, exactly. Yeah. So you just kind of have to eat part of that. So when you're pricing out a flip, you need to price in some repairs. Like if you're leaving something open to an inspection, like one of our recent flips, like the roof, it needed to be done, which is crazy that we didn't actually have to do it. We had some other seller concessions, but we did not have to do the roof. But I looked at it and I was like, so yeah, this roof, I'm not going to replace it because it's not actively leaking. I'm going to clean all the leaves off it, make it look good. But I fully knew like, hey, if I'm going to probably have to spend $10,000 doing this. We didn't spend $10,000 there. We spent $10,000 there helping pay the fees for the buyer. But it was just kind of like a realization of like, yeah, this is how it's going to happen. And every offer I've gotten since right now we've got, I think 6 properties listed. And I mean, anytime we're getting an offer, it's coming in. It might be at ask or slightly below, but they're asking for things to get paid.
Yeah. Like 5 to 10, or maybe not that much, but like in closing costs, settlement charges, like rate buy downs too is another one. So, and I guess now as if we're underwriting too, here the prices haven't really gone down. They're on the market a little bit longer. So now your holding costs are a little bit longer, a little bit higher. But at the same time, you just have to like maybe on the rehab, if you did a 10% set aside for unexpected, maybe it's 15%.
Right.
You got to just account for something, because luckily on this specific one, we're still going to make, I think, like 30 or 35, but it went from being a great deal to like, it's still a good deal.
Doing a deal. Yeah. You're making money. You're not upset about that, but yeah.
Yeah.
That's an issue. And the funny thing I've seen too with some of these buyers where we kind of push back on this, their agent, and they could be just bullshit, but they're like, no, literally, they have no money. Like they can't even do their down payment. I'm like, why are people buying it? Like that's a terrible choice. If you don't have enough money to like own the house, like without getting concessions, you shouldn't buy the house, because right now is not the best time for home ownership. Like the American dream isn't thriving in home ownership right now.
No, I mean, rates are still kind of staying kind of where they have been right now. So like,
yeah,
I don't know. I think, I don't know how it is in Spokane, but like Cincinnati specifically, our listings are up like 27% year over year, which is like, it's June, May, June.
Wow.
But our average sale price is still up 5%. So again, like it's kind of like stagnant on the price.
Not crazy.
There's a lot more of them.
Yeah.
But our days on market are a lot higher too. So like 51% higher year over year for cumulative days on market.
That's for Cincy?
Cincinnati MSA.
Wow. Interesting. Yeah, we're definitely seeing numbers go up. I saw an article. Was it an article? Podcast article, whatever. I don't know what it was, but they were talking about there's 500,000.
Oh, I saw the same thing. Yeah. More sellers.
What was it 500,000 sellers than their buyers?
I think that was posted out of like a North Carolina, like suburb or like North Carolina like jurisdiction. But I think that's true in several markets.
What basically saying is there is more sellers than there are buyers right now, which we obviously can understand. That's why it's a buyer's market, and buyers can make offers with, concessions and repairs and all that sort of stuff. We get it.
I think if I'm forward thinking a little bit, if you're looking at Q4 specifically, like, yeah, right now seasonally, like things still kind of go here and there, but it was slow kind of last winter. I mean, if you're taking on a project now and it's a 6-month rehab or 4 or 5 month rehab, that's something that would maybe, I don't know. I'd be a little bit more cautious with that, I guess.
Yeah, that's interesting. So on the Scale community call today, I shared just kind of, one of the members asked what we're doing, what our strategy is going forward. How are we going to transact with real estate? And, we're feeling the June slowdown. I don't know if you're feeling it the same way, but our lead flow is quite a bit lower than it was last month. But we see that in Washington at least. And I know on the listing side, like the actual market, you see the same thing, just like you do off market. And I think it's just a byproduct of summer starting, kids getting out of school. It's like a transitionary season for a lot of people, especially in the northern climates. And I would expect it to ramp up towards the end of summer into the fall before it slows back down in the winter. However, I would say I am not trying, to your point, I'm not trying to take on huge projects that might take me 6 months to finish. And then I'm going into the winter market to sell it. We personally have 3 or 4 active novations. We're actively flipping one house, and then we've got like 3 or 4 wholesale deals, and maybe one other listing. I can't remember. So I'm kind of like topped up for our size of company. I'm kind of topped up. I don't want to take on another major flip. Oh, that's right. We're buying another one. That's the other one. We're buying. Actually, we have 2 more in the pipeline we're supposed to be closing on that are on the higher end of they're a little over our media price point, which is not good for us, but they're fat deals. So we're thinking about taking them down.
And you guys are taking these down?
One would be a wholetail. One would be slightly more than a wholetail. Yeah. So that I'm topped up. Like I don't if you come at me, I'm wholesaling it. Yeah. I don't even want to do a novation unless it's got a good margin on it. Cause I just don't, and the novation needs to be like less than like $3,500, $5,000 in repairs before, you know what I mean? I just don't want to deal with it because you get all your capital tied up.
You get all your capital tied up and your resources, man. Like,
exactly.
Not the name is not that much, but hold on. 1, 2, 3, 4, 5, 6. I'm looking on our whiteboard. 7 that we have like literally legit like title on and going through rehab. So I'm doing all of the project management on.
That's a lot.
Yeah. And then there's a couple more. There's I think 3 more that are wholesales. One's clear to close for Monday. Another one for the 30th, those are 2 good ones. But then we're going to close another one, I think on the 27th, which might be another wholesale. But I have to get the tenant out of that one. So like, it's tough because like as an entrepreneur and someone who's like has a revenue goal, I'm like, yes, I will take on all I'll figure it out. That's always been my mentality. But at the same time, like it's stressful and you gotta like sometimes balls get dropped. It's just part of it.
They do. It's inevitable. And you just have to understand like what your business is doing. Like where we're at, like we're just taught like there's no reason for us to take on any more risk. Where we're at, we're going to be making money. We'll be able to chip away and make some wholesale fees to bring money in. And then we'll have our cash out on these flips and novations that we've already got going. And then we'll just slowly let that trickle back. And that's kind of how we as our company, how we've done it recently is we're putting money out there and then it'll slowly come back in, kind of like a tide. But then in between that, we're just popping off these little, sometimes 50K wholesale deals, sometimes 10K, but you just pop those off and that kind of recovers our marketing. Yep. But then all of our real profits, not all, but a good chunk of our real profits, probably 60% have come from these like flips, novations, wholesales that were the long run profits.
You take title, you control the asset. Yeah. And those 5 to 10 to 15K wholesale fees, I tell a lot of new people, like, those are what keeps the marketing going. It's what keeps the lights on. But you really need the 40, 50, 60 ones to make any real money in this business.
Totally. 100%.
You can give me about 36 seconds. I just want to share our SCALE community with you. So SCALE stands for Scaling Cash Flow, Assets, Leverage, and Equity. And it is our exclusive community for real estate operators looking to take this game seriously. In the community, you can hang out with myself, Dan, Dylan, and other operators around the country who are all working to be the best in their market. We recently did a survey, and every single member said that the community had directly contributed to major growth experienced in the last 12 months. On top of that, you get all of our processes around marketing, sales, building a CRM, and you even get preferred relationships with Lowe's and different financing/lenders so that you can get your deals 100% paid for without a headache. So if that sounds like something you're interested in, go to collectingkeys.com/scale. Let's see if you're a good fit.
So transition, I got a couple topics I do want to talk about. One, we talked about interest rates. The Fed is meeting today.
Yeah, I think it's today.
On interest rates. The FOMC is meeting today, and they're going to announce like tomorrow at, I don't know, was it like 11 a.m. our time, so 2 p.m. your time probably.
Yep.
If they're going to increase rates. What do you think?
I think they're going to stay flat.
Sorry, not stay flat. Are they going to stay flat or are they going to decrease? So you think stay flat?
I think they're going to stay flat. The jobs report was not too long ago, and it was not great, but not like it was basically at expectations.
Yeah.
And the Fed calls their meetings forward guidance.
Yep.
And the last thing that they try to do is, I feel like they portray what they're going to do ahead of time. And a lot of the Fed commentators that I follow on, X and stuff, basically said like, I don't anticipate any kind of cuts happening. So them actually cutting tomorrow would be like kind of a surprise to the market. I don't think they like that. They want certainty.
Yeah, they want certainty, right? Yeah, that's actually good. I agree with that. They're probably going to stay flat. It just doesn't feel like they need to cut. Like it just doesn't feel, maybe they do need to. I don't know, but it doesn't feel in the moment that they need to. The inflation is going down, which is good, right? It sounds like anyways. So what's the point in letting it pop back up by exciting the market and dropping rates,
Yeah. And then the inflation number that was lower. The rate of change was lower to, get the definitions right. But so to them, that's like, well, there's no they're worried about inflation, right?
Yeah.
So if they cut rates, that would be the worst case scenario for them.
So in that same vein, then I can't quote facts on this because I was listening to the All In podcast recently, and they were talking about, one of the hosts was talking about their forecast for GDP in Q2 is actually like 3 point some, like low threes. That to me is crazy.
That to me seems pretty crazy too.
Yeah.
It's usually the Dallas Fed that gives out their GDP ones, their metric. I don't really have much other to say than that seems pretty high.
Right, because we're coming off of a negative quarter, Q1, right? Q1 was it negative?
Yeah.
Negative growth?
Yes. And there's a guy named Dr. Lacey Hunt. He was actually the Dallas Fed president, and I listened to a podcast with him. He actually thinks that a lot of the numbers are kind of wonky right now. And a lot of it was because like some of the tariff stuff, when they got announced, a lot of people front ran a lot of their spending. So he thinks that the previous quarter, even though it didn't look great, looked better than it would have if those tariffs were announced because people front loaded their spending.
So there is an argument then, the argument from the All-In was that there's $300 billion coming in potential in government receipts, essentially basically from tariffs and other things. So there'll be like an increase to the U.S. government of $300 billion. So that's a good thing.
The revenue is going up, but if you see the big beautiful bill, those deficits are still getting bigger.
Right, because there's a lot of tax cuts in there.
Well, the tax cuts are the same from 2016 that are just getting renewed. So they're not really tax cuts. It's kind of staying the same and not going back to what they were pre the Jobs Act.
Yeah.
And quick aside, we can talk about bonus depreciation because that was mentioned in that bill.
Yeah.
But I don't know. I think even though revenue is going up, I think the spending's going up more than the revenue.
Gotcha.
So I'm still that the deficits are going to widen, and secularly, not like short term, but like I think we're in an inflationary decade. And if you're in an inflationary decade, you want to own hard assets, and hard assets, it's real estate.
Yeah.
Some stocks, other things, So
yeah,
that's how I've kind of positioned my whole portfolio.
So do you think we're in like the 1980s decade, the late 70s to late 80s?
I don't think we'll be able to get to those high of interest rates again because our debt's too bad.
No, but that was like the last time we would have seen like a decade of high rates.
Yeah. So you have widening deficits, you have deglobalization, you have all the geopolitical problems coming back. So yeah, I'd say, I don't know if that's an analogous decade, but probably the closest one in recent memory.
Right. Like, yeah, that's all I could think of as far as like, okay, you had high rates for a long period of time. And I never actually looked at it this way, but when they raised the rates, was Paul Volcker, was the Fed chair that raised the rates super high. But then really, it was a rate cutting environment until like the 2000s.
40 years.
It was forever, right? Isn't that crazy?
Yeah.
But they jumped them up to like 20%. So they slowly, all we knew for that period of time was, well, just utilize rate lowering to keep the economy pumping. Lower the rates until they couldn't, because then they were at zero.
Because they're at the zero bound. Yep. And that was the great financial crisis.
You could go negative, which some countries did. Japan's negative. I think Canada at least was negative for a while.
Europe was negative for a while, but I don't want to get into the semantics. It's a lot harder to get a negative interest rate when you're the reserve currency for the world.
Of course. Sure. Yep. Okay. That makes sense.
So I guess I don't know where to top that off at, but the big like global macro pictures, like real estate did well over the past 40 years because they had 40 years of declining interest rates.
Right.
We might not have that going forward, but that doesn't mean you still can't make money. And it's not like one of the fastest horses, to use that analogy.
Well, so do you need to own, you said own real estate in an inflationary period. I mean,
hard assets. Yeah.
Are you going to cash flow with your real estate while you own it?
Here I will.
Yeah.
I mean, that's not true for all markets.
Yeah. Yeah. Some markets you definitely won't.
But even so, like that with the off market business, Dan, and like with my current portfolio that I've established over the past couple of years, I have the cash flow from that, but the money's really made in the appreciation and the debt pay down.
Yeah.
Right. And so I don't see a reason not to just keep riding that train because I don't, even if we have a short-term price correction, if you ask me 10 years from now, if my prices are going to be higher or lower than they are now, I think they're going to be a lot higher.
You think so? Yeah.
Yeah.
Yeah. And you're going to have the spread because you will have the debt pay down.
Exactly.
That, which is great. Yeah. And I was kind of asking around this because it's almost like if I asked you this question differently, as in if you were a pharmacist and you're making excess income, would you take that excess income and buy rental properties off the market?
No.
Exactly. Because it doesn't make sense.
Yeah.
But you have a unique tool and skill set, and a lot of our listeners do, which is find things at a discount, add value to them. So now you're forcing immediate appreciation and then buy them in such a way that you can hold on to them. So if you want to go long in real estate, you need to buy them in a way which everybody knows, you make your money on the buy, which is true. But you need to buy them in a way that you can force a quick bump in value, because also that protects you in the near term if you do need to sell an asset. You've created some value where you're not losing money. Because here's the shitty thing about real estate. You can literally buy an asset and sell it for more than you bought it for and lose money on it.
Yep.
It sucks.
Yeah. Yeah, depending on how much money you poured into it during the life of your ownership.
Absolutely. But think about it. If you just bought it, paid $100,000 for it, and you sell it next year for $102,000, you're definitely losing money because there's transactional costs. And it's interesting where like I was running this through my head in the shower the other day. So in Washington, we have essentially a 2% excise tax. Anytime you sell real estate, you pay 2% no matter what on gross proceeds. We also have a B&O tax that's on gross sales of 1%.
Jesus.
It's stupid. I don't agree with gross anything when you're talking about taxes, but it's less than 2%. But for this argument, it's 2%. So if you basically buy a house, or you sell a house for $400,000, say you owe $300,000, so you have $100,000 in equity on this thing. So $400,000 times 2% is $8,000. You just paid an 8% tax on your gain.
That just goes to the state of Washington.
Just goes to the government, goes to the state of Washington. That's an 8% essentially capital gains tax. but they don't have a capital gains tax here, right? But they do. I mean, actually we do now, but but you know what I mean? So then on top of that, you're going to pay the federal government your potentially say 15, 20% capital gain on that, depending on what tax bracket you're in.
And bonus depreciation or that depreciation recapture.
Yeah.
Yep.
So you're getting it really pays to own real estate over a long period of time, but you're going to get taxed on that shit.
Well, the biggest thing in the R-off market space is are you trying to go cash flow or are you trying to grow wealth? And we talked about the massive income versus passive income. So yeah, make a shit ton of money. But the way that I'm adding to my portfolio now is you buy at 75% of ARV minus repairs.
Mm-hmm.
So that way I'm all into a project with very little money. They're not always perfect first, but very little money in. So let's say I'm buying $90,000 worth of equity for 10 grand. That's an $80,000 spread. Do that 5 times a year. You just made 400 grand on paper.
And you can't do that any other real way in real estate unless you get lucky. You can't do it consistently. And that's what I say is you can't build a business buying shit off the MLS or getting lucky.
Yeah. I mean, the wholesaling and the flipping provides some of the capital for that. And then tying this back into the big, beautiful bill that they like to call it. It passed the House reviewed it. They made some of their alterations. It went to the Senate. The Senate just reviewed their remarks yesterday, and they brought back 100% bonus depreciation, but in perpetuity.
Oh, wow.
So it doesn't go away. So that'll be another avenue for I would just say high W-2 earners to park some of their money into.
Yeah, totally. Interesting. If that comes back, I don't know how I feel about that. I don't know that I would necessarily use it all the time.
Well, you can be strategic with how you use it too. You don't, it's not an all or nothing thing.
Yeah. I would feel like we'd be remiss if we don't talk about the Tel Aviv real estate market and anything else going on geopolitically, because we talked about, you mentioned it. I mean, what do you think? Shit's popping off.
Like I said before the podcast started, I'm not informed enough to actually have a really good opinion. I just think that if the United States gets involved, markets will probably freak out. And then it's going to depend on how quickly that gets resolved. I think that'd be a downward, a stair step down as things kept escalating. But as soon as things resolved, I don't see a reason why it wouldn't go back up.
Right.
But no one knows that timeline.
Well, exactly. There's this shock, which, the headlines right now are nobody cares. Israel and Iran are bombing each other. That's just a Tuesday afternoon in the Middle East, right? So because the markets aren't doing really anything of note.
Yeah.
If the U.S. announced something that's big, then I think the markets would react. But again, it could be an 8-day thing, a 10-day thing, and all of a sudden we're back to it. So it's you can't just bank on something's going to happen because you think it should. I will say I saw some shit on Instagram where I saw I think it was F-35s, the Israeli F-35s flying in Iranian airspace, and they're bombing shit. I was
yeah,
this is real. This isn't launching. This isn't launching missiles anymore. This is they're really fighting.
From a purely real estate perspective, though, if the United States gets involved, people would flight to safety, which means that they buy a shit ton of treasuries, which means rates would likely go down, which means that you can refi or sell at a lower rate. So do with that information what you will. But
okay, so are we pro-war?
Nope, not going there. Not going there. Oh.
So it does bring light. There has been a lot of conversations. And so if you want to be a doomer, like our comrade Michael, who sometimes is a doomer when it comes to this geopolitical stuff, the China-Taiwan thing could pop off too. What a better time for China to go over to Taiwan when there's all these tensions, and it's a strategic move. So then you have this whole other layer of issues. And then my conspiracy is that the riots going on around the country, or protests, whatever you want to call them, I think they're riots, are psyops into America to allow for this open gate for people to go to war. So Israel's all right, we got those fools distracted. Let's go bomb this. Let's go bomb the shit out of Iran and say we're going after the nukes. China might just slip through the back door down in Taiwan too. Who knows?
The older I get, the less I trust the government. So that's just because of things that happen, right?
Right. That's exactly it. You see it, you're what's going on here? And I'm not saying that protesters don't believe in what they're protesting for, and they aren't protesting for something that they think is important. I'm just saying that it's potential that there's some psyops to really force those things to happen quicker in a larger scale.
And with that, I want to move on to the next subject real quick.
Conspiracy corner over.
Yeah. No, one thing I think we mentioned, honestly, months ago that's finally starting to come to fruition is we saw in the Go Bonus channel of like lenders reaching out to some of the people, like basically the Go Bros, and saying, hey, we got some bad deals on our books. You want to take this over for what's owed?
Right.
And I think we're going to start seeing more and more of that. So if you're a deal hunter, maybe talk to your favorite bank. Maybe talk to a local credit union.
So interesting on this one. So to highlight this was a commercial asset. It wasn't residential, was it?
It was commercial that in the specific post.
Yep. That's where I'm wondering. I do think that there's a lot of stressed assets in the commercial space, triple net space, larger, multifamily, that part of the residential space. I feel like you're not going to see as much of that in the single family, small multi, because I think those assets, not all of them, because if you've bought in the last few years, you're upside down.
For sure.
Hands down, right? But as we still have a decently strong jobs market, people are able to pay those mortgages. And a lot of those lenders have a mechanism now to be like, oh, we'll just tack it on the back end. Don't worry about it.
Yep.
And they're just cha-ching, increasing the value of that security that they're going to wrap up and sell. But I do think on that commercial side that's where the distress is going to be. Especially you have all these dummies that are like getting SBA loans and I'm buying a business, you know what I mean?
Yeah.
And then those commercial assets that are along with that business, the office building or the warehouse or whatever, I think that's a great opportunity.
The past 5 years, you kind of got bailed out even if you bought a bad deal. That's not really the case anymore. And like my mind goes to you're an FHA buyer for these, let's say you bought a 4 unit, but you're a typical, American that doesn't really have any money and you need the rent from those 3 other units to pay your bills. Okay, well now a tenant just moved out and they ruined your place and you don't have the money to fix it up.
Yep.
Okay, so now what happens? You got to rent it for half the value and then it happens again? Like, I think we might start seeing some of that. But
there's definitely some of that. And I think also in your boy who loves co-living or whatever, was that what he calls it? Co-living? Craig.
Yeah.
If you're overpaying for an asset because you're going to try to do co-living, watch out. It's the same issue. And I'm not saying that it's not a viable solution. I'm just going to shit talk on Craig. And also, you saw that with Airbnb. People overpaying for assets because they're like, oh my God, the agent told me we'll make $1.2 million a year for this beachfront property. It's like, yeah, but it costs you $1.1 million to operate or $1.3 million to operate. You know what I mean?
Yeah. But you can't put on Instagram that you own a beachfront Airbnb.
Yeah, this is true. And that you never get to visit because you can't afford to take a week off. That's what it comes down to.
Yeah. And I mean, those coastal areas are just getting more and more and more stressed. So
they are. But your point is well taken. I do think that is an opportunity. Maybe it is cracking a little bit. Maybe these banks are going to have some REOs to release to people. I do think I saw someone talking about getting a couple REOs from a bank too.
Yeah. They basically haven't done any in the past 5 years, but now they had a lender reach out that said, hey, we're going to own these in the next couple of weeks. Are you interested?
Right. Did that person make a comment that the lender also said they're going to have 12 more coming up?
Yep.
So they know,
It's increasing in space. Yeah.
Interesting.
In volume.
Yeah.
I should go back and see where he invests in.
Yeah.
If that's a local thing or not.
Yeah. That would be interesting. I every once in a while talk to my commercial banker who does all of he helps. He's kind of our private banker as well. He kind of wears a few hats at the bank. But anyways, he does all the SBA loans for small businesses and stuff like that. And then he helps them restructure their debt on their buildings and stuff. And I'm always every time I talk, I'm like, hey, anybody losing their ass? Anybody buy a business or a building that they can't afford to pay? And he's like, no, not yet. So maybe I'll ask him this next time I talk to him.
Have you ever heard of anyone actually getting denied for any of these loans?
For
I guess an SBA loan for one, but even if you're buying as long as you have the down payment, like a 20-25% down,
no,
we know they don't have any money, but they always get approved for the loan.
Yeah. I don't know, man. I've never heard of somebody get denied. I just heard of people not qualifying or having the equity in their primary house to give up to Uncle Sam when they don't make their payments.
Yeah. I guess you're signing your life away and probably not even realizing it.
Yes. Anyhow.
Do you guys have any, real quick, do you know what the space or I guess with your lending stuff, can you do any non-recourse loans?
We won't know.
Yeah.
I haven't ran into any situation where non-recourse actually came up. And I was talking to somebody, I can't remember who I was talking to, a lender, and they're like, well, there's technically no such thing as non-recourse because they'll say non-recourse, but you're still on there's still some recourse to every type of debt you do. And so I never really vetted that out and asked them exactly how that works, but that always stuck with me when people bring up non-recourse.
Yeah, I'm trying to look for, there's a guy I follow on Twitter. He's a local syndicator to my market, but he actually knows what he's doing. He's been doing it since like the early 2000s. And he just posted the other day here. Fresh cash out refi quote came in for our 220 unit. This was only 6 days ago. A Fannie debt, 5-year fixed, 5 years IO, 65% LTV. They did a max buy down that was 4.94% as of today.
Wow.
So like the government debt, the non-recourse government debt's almost better than I think some of the other stuff that you can get out there.
Yeah. Yeah. Especially because you get the interest only period to build up your cash reserves.
Yeah. So, I mean, maybe we're in the wrong space, Dan.
Probably, but that's okay. I'll keep chipping away.
Yeah, me too, buddy.
All right, let's close it out, man. We went on for a while. Sorry, audience. Me and Dylan we're just talking shop over here.
Not sorry. You guys enjoyed it.
You guys loved every minute of this. All right. This is from your host, Investor Man Dan, and the baddie from Cincinnati, Dylan.
I hate that.
Go hit him up on Instagram at Dylan Does Deals and let him know he is the baddie from Cincinnati. And other than that, have a good week. See ya.
See you guys.
Thanks for listening, everyone. If you want more from us, you can shoot us a follow on Instagram. I am at Mike_invest. Dan is at InvestorMan Dan. And Dylan is at Dylan_does_deals. Shoot us a follow and send us a DM to let us know what you think of the show.